At the Booth School of Business at the University of Chicago. I have two friends' kids that have you as a professor. Their name will go unnoticed. I will not mention their names. They're terrified, perhaps, of this interview. Professor, welcome back to CNBC.
I hope not. Oh, my goodness.
Listen, I think, do we care if it's 75 or 100 basis points tomorrow?
I think we do, because I think if the Fed surprises the markets and goes 100 basis points, that suggests they're much more worried than we think they are. And I think that would cause a lot of tumult. But I think it's pretty clear that they'll go 75. I don't really see why they would need to move 100 basis points. I don't think they were that surprised that the core inflation numbers were not coming down, because rents are such an important driver of that, and rents are lagging. I think they will start to grow at a lower pace, but not yet.
And what do you expect them to say? Because you know what I mean. As a former Fed governor, you had to break out your thesaurus every time you wrote a statement. What is this? How's the market going to interpret this word versus that word? What do you want them to say? What will they say?
Because it's exactly, if you look at the transcripts as they're published with a 5-year lag, you may be surprised to find that most of the discussion is about what to say rather than whether it's 75 basis points or 100 basis points. There's usually pretty clear consensus on that, but what to say, there's a lot of discussion about that. So we're going to be getting some forecasts out. Undoubtedly, they are going to be forecasting, or at least I believe they're going to be forecasting to have a 4 handle on interest rates by the end of this year, and forecast to probably be between 4 and 5% for most of 2023. So I think that they're going to be trying to talk through that to make sure that they are maintaining their credibility, their inflation-fighting bona fides, which I think they have, because inflation expectations have come down over the last month. They didn't get out of the range they've been in for the last decade, so they weren't too far gone. And now I think they've really bought a lot of credibility.
You know, we talk about rates all the time on this network as it pertains to our viewers' investments. And we should, and we care. We care about their investments, right? We are the worldwide leader in business news. But I worry more, Randall, spending a lot of time in the Midwest, north of where you are, what these rates are going to mean for the average American household. Given the rate of revolving debt, credit card debts at record levels, many other debt levels, debt service, I get it, is manageable now. Can the American economy withstand 5% interest rates, 6% interest rates?
So certainly these are rates that in the old days, those would have been good rates. These days, we think of them as being particularly high. I mean, obviously, the increase in rates is having a very big impact on mortgages, and then the consequence of that is impact on housing prices. So people have 30-year fixed-rate mortgages. They're okay in terms of the debt service, but it's going to affect the value of their house if they come to sell it. And we're sort of seeing some of that downturn in many markets now. So I think that has an important impact on your average household. And as you said, other borrowing costs will be going up. Now, potentially, hopefully, on the positive side, eventually we'll start to see some checking accounts and savings accounts pay a little bit more than they have in the past, although they've been pretty slow to raise those rates.